everyone. It's great to be here today. So, talking about Japan, this is one topic that I would like to share with you all of this often overlooked investment opportunity that you can find in the East. So, just imagine there's a race between a rabbit and a tortoise. But in Japan, what we are seeing is a complex story between a tortoise and a cheetah. That's how it has been unfolding over the years. And today, we're seeing how Japan actually evolved from being just simply associated with a mature economy, industrialization, to today undergoing a structural transformation. Just a quick overview of the disclaimer before we go into our presentation. So imagine Japan is currently a shy, a conservative, a very intimidating person who is perhaps somehow underestimated. So how are we seeing the potential being revealed over time is that it could be a hidden gem that yet to appear in your current investment portfolio. I hope after 20 minutes, perhaps you can have a second thought and find the investment opportunity within this land. So another key things that we actually pay attention to is how Japan actually crawl back in order to catch up with the global economy. We see significant growth that already happened in some of the developed markets. Just to name a few, US, Europe, or even emerging market is actually coming under your radar a few years ago. But Japan is not actually losing out. Few years back, it may actually embraced with negative rate environment. But have you ever noticed just recently in March itself, BOJ finally take a step forward to improve its to actually step forward to its policy normalization. In other words, increase its interest rate. So we're seeing a positive development within this land. Just to scream through with a hard truth, I believe that for many years, Japan equities has hardly come under your radar as well, which actually happens similarly in the global markets. Global investors actually recognize there are a lot of struggles that Japan actually battling with. Some of it actually has stayed in the past, and moving forward, what we are seeing that Japan evolved from the lost decade is actually another bright story. So when you may have already think that Japan is already a mature economy, but what exactly is actually behind all these key economic drivers? First, we see industrial normalization picking up at a strong pace ever since 1970s. So even though Japan was one of the early adopters of quantitative easing, what does it mean? It's actually being very generous in their spending, as well as putting their rates at a very low levels that you can hardly see in other countries. Other than this, perhaps what comes to your mind is Japanese cars. Those brands like, for example, Toyota, Nissan, these are not uncommon, and we quite a lot of them actually on Malaysia. So we are actually quite a fans on Japanese car exports. What else? What Japan has shown its edge is in terms of the pace of innovation. So over the years, not just focusing on our attention to US, where we see a lot of venture capital rising, a lot of IPOs actually playing out more aggressively in the US, Japan itself has a well-built structure already. So what we see is robotics, in automation, and all these actually are the green shoots in Japan currently. So just a few glimpse through, I believe that many of us are very familiar with the car brands already. However, do you know that even though Toyota being the one that actually sell the most cars in the world, and it comes from Japan, overall, on a broader perspective, Japan's automotive sales still somehow lag behind the economic blocks, the two big players, US and China. Of course, this is not something that we should count Japan off the playbook as of now, because China obviously has the highest population, and obviously this would translate into more sales and mass production. Whereas in US, there are more players who can be more adaptive and competitive as Japan players. Just a quick check. I believe that sitting around here, quite many of you are actually our keen reader of our research articles. So I've been calling Japan for quite a number of times over here since second half of 2022. This has been coming under our radar. So we actually issue quite a number of buy calls for Japan ever since before it actually picked up its engine to record a 30% upside last year. as of today, it has already marched forward to be one of the leader in Asia with 18% upside. So for those of you yet to take a seat in Japan, perhaps it's also an opportune time to actually ride on the momentum as well. So what are some of the key factors that we look into and we keep mentioning over and over again even though after Japan has made so many new hikes? So some of it will be policy normalization, which has already happened at a very gradual but steady pace that is actually very effective in Japan's economy. Secondly, we also notice that governance reform, which is essentially trying to encourage a better business practice within the big corporates in Japan, as the likes of small caps as well, that they have to increase their shareholder return. One thing that one key message we can get from here is that they want to attract more investor, not just foreign investor, but at the same time encourage local investor, especially among the retail group, to actually participate in the upside of equity market. Secondly, we notice that reflation is one of the key impact that we see from governance reform. So reflation itself, you may be wondering, isn't inflation a bad thing? Isn't it something that US, Europe, EM has been trying very hard to tame it after COVID? Well, in Japan, inflation is slightly different. It plays a slightly more important role and actually induce a positive impact on the economy. For now, I will be elaborating this more on inflation story. And lastly, we are still optimistic on Japanese yen, even though we are seeing quite a number of time actually surge upward to try to a higher level, with currently the 160 level against US dollar could be the new key defense line. However, there is still optimism that we should pay attention to Japanese yen. And today, I would like to bring your attention more towards how Japanese deserve a part in your portfolio because of relative undervaluation compared to global peers. And secondly, foreigners are coming back to this attractive land. Many of you may be wondering, it's already regained its 40,000 mark. It's actually a height that we have seen back in 1990s. How much upside potential still exists? Well, whether or not Japan has lost its shine, look at this chart. It's a rock bottom that Japan has actually experienced in the past. However, the round bottom recovery is what we are paying more attention to today. So it actually regained its last decade peak back in February, where we reiterate our investment call and upgrade our fair PE to 20 times. This indirectly translates that we are very optimistic on this land, and some of the reasons could be come from the pivotal moment when POJ actually charted its step forward for policy normalization. This is something that I actually mentioned earlier, which is one key thing to actually see positive interest rate in Japan after 17 years of sitting into negative territory. So what we are seeing is that why this rate high actually happens in March, because it coincides with the spring wage negotiation, which is an annual activity that the union labor in Japan actually gather everyone to actually fight for higher wage growth. And this time, it seems like they have won the victory with a 5% wage growth achieved, which is unprecedented in the history. On top of this, the markets going forward has been expecting 2 more rate hikes, which should inject extra boost to the equity market. You may be wondering, policy normalization is obviously a great thing, but how rapid, how much impact we can see to translate into equity markets? Well, to manage your expectation as well as the investor worldwide, we should expect a more gradual, a more steady, and a more measured approach towards this policy normalization journey. Why so? Key differences between Japan and the global economy, where it lies, is actually sitting within the government bond yield. you still see a distant gap, which even though compared to December 2022, before Japan markets actually rallied, the gap has narrowed significantly. Even though this is a good improvement, but we still have to acknowledge the significant a wide gap that remains between Japan government bond yield and the rest of the G10 countries. Hence, moving forward, this also translates that there should be bigger upside potential, where riding on the economic engine is still not too late. So looking further, what actually policy could actually help the entire economy is the confidence that it can bring to local investors as well as foreigners alike. So local people are actually been saving out, piling up their hard-earned money over the years because they have lack of confidence in their own economy and inflation. Hence, we do not really see a spike in the real estate. We do not really see asset bubbles like what we've seen in some of the countries after COVID-19. Hence, for Japan itself, there are two key things you have to look at when you evaluate the effectiveness of policy on inflation momentum. First, the inflation number itself. We pay more attention to the core CPI, which actually excludes some volatile items, while at the same time, you pay more attention to the real cash earnings of the people. So what does that mean is that even though currently we see actually quite an encouraging and promising signs that inflation is making its way back to about 2 to 3%, just like what just now in the panel question in Q&A, I saw that quite a number of you are concerning on the strength of CPI and how BOJ should react to this. So this slide should explain to some extent. Well, on the bar chart, you see that real cash earnings still sitting in a negative territory. What exactly it means that people may be more reluctant, more hesitant to actually spend aggressively. So we need more patience in order for us to see a strong recovery of demand that could inject a stronger momentum into the equity market. On this note, you may be wondering, inflation is coming back. So it's not really a scary monster like what you have seen in US, Europe. In Japan itself, corporates are actually welcoming the rising inflation in Japan economy, well, on a stable manner. So how does that being reflected? It's actually in their financials health itself. So we are seeing earnings surprises, means market is very is being surprises because corporates make more than they can think, and the profit margins is actually increasing because of rising inflation. Why so? First thing, they are able to pass through the rising cost to consumers, while consumers have to actually bear with it and trying to adjust their consumption behavior. On the other hand, a number of them are actually strong corporates with already sound fundamentals. In Japan, there are a number of zombie firms, which is actually one of the characteristics you rarely see in other countries. So these zombie firms, how do they survive? How do they survive in the past, even though there are a lot of conglomerates staying in the game? So because of negative interest rate, because of low borrowing costs, hence these firms are able to steer through the past decades. However, coming to today, with policy normalization taking place, with inflation showing its colors, some zombie firms will be phased up substantially. Ultimately, you will see a restructuring in the whole corporate dynamics, where there could be more more consolidation, more acquisition in order to see a stronger corporate landscape. So one thing you can take note to actually see how structural governance reform is taking place is actually the improvement in terms of PB ratio. What exactly this tells us is that it's actually rather effective in Japan economy. Well, over the time, since Japan actually started their initiative last year, quite a number of countries, like not common to us, China and Korea, also follow suit and try to implement in their own country. However, from our point of view, we find that this strategy works better in Japan because Japan has a more straightforward, has actually catered their strategy to target at Japanese using a shame and blame approach. How do they work around this? Is that for those who fail to comply, who are not improving their PB ratio, who are not trying to improve how they actually make use of their idle cash to boost shareholder return, will eventually face the risk of delisting in the stock exchange. Hence, over time, we are seeing a shift of the PB chart from left to right, that more and more companies are improving their ratio to go above the requirement of 1. So this actually is very strategic, because Japanese people, they tend by native, they actually tend to avoid public shaming. So it's rather an effective strategy that's practicing in Japan. So third, I would like to bring your attention to how foreigners has refound this hidden gem. Back in 1970s, only 5% of the equity market is actually owned by foreigners. And up to 2000, when .com bubble burst, the shareholder ownership of foreigners actually increased fourfold to around 20%. And up until today, a third of the shareholder market value actually belongs to foreigners. So this actually is another reason that even foreigners, big funds, institutional players are coming back to this forgotten land. So another thing that I would like to highlight on the how the momentum of foreign funds has been playing around since a year ago. There's notably there's a lot of sharp drawdown, which we noticed during period of U.S. Treasury yield upsurge back in third quarter last year. Also recently, BOJ signaling effect. So for BOJ, right, they are quite more methodological central bank. Whenever they are trying to conduct a move, they usually will communicate or release some signals to the market. So indirectly, for market participants, usually some of them may be able to capture on the opportunity and load up on the Japanese equities before the move. So like what we've seen in the anticipation of BOJ policy action back in February, there's a large inflows of foreign fund into the Japanese market. However, what explains to the large outflows that actually offset some of the gains back in February is because when BOJ make a move to actually increase policy rate, they actually downplay some market expectation. So market actually expect when you do something, you should do it like at a more rapid and more at a bigger scale. However, BOJ still remain rather accommodative and rather soft in their tone. So they are being very dovish. This one actually brings a negative surprises to the equity market. Hence, we see a slight outflows. However, fret not, a lot of foreign funds actually return to this land. However, some of them may be reducing or managing the exposure because of the persistent weakness in yen, which we'll be talking this later on. So, talking about the elephant in the room that many of you might be concerning, Japanese yen. Are we still bullish on this currency? Ever since we first called about Japan, we encourage investors to take an unhedged exposure in order for you to capture the upside potential. So how has Japanese yen behaved recently? Well, for Japanese yen, given that all this while, Japan sitting at a very low rate environment, due to this, a lot of Japanese has been taking advantage to use for carry trade. Henceforth, we see a rising position in short sellings. A lot of them are not really afraid of BOJ intervention, to be frank, and they're actually trying to reload and reposition into Japanese yen even after BOJ come to rescue to support the Japanese yen. On the other hand, we see quite a number of participants are very bearish and hold a pessimistic view towards Japanese yen. And that's why you see that the hedging cost is increasingly cheaper. And because of this, we do see global sentiment plays a significant role in Japanese yen strength. So what we see over here is that even though a number of you are concerned that if Japan is coming up back to 150, then another 153, 155, and currently 160 level seems like the new high that it has achieved over a short period of time. However, the backbone here is that BOJ normally comes in to actually address a rapid depreciation in Japanese yen. So it's actually quite strategic because usually it comes in at a time when the trading volume is very low, so easier for it to manipulate. And secondly, it also coincides with key economic events. And last time when it intervened back in May, usually it's a time when Fed is giving a strategic speech. So all in all, you may say conventionally, weak yen is actually favorable for exporter, where exported-oriented industries is the primary driver of Japan economy. Well, this is a fact, and quite a number of companies' names you see on the screen itself actually are those who actually contributed to Japan's economy, and much of their earnings come from overseas, from just 45% on average in the past to now around 50+%. So this is one sign that we are seeing yen playing a significant role. But this shouldn't be a reason that you say weak yen, that a stronger yen is bad for exporter. Because in order to navigate the challenging path, the companies are actually quite smart. They are more prompted to actually innovate and invest more into cost-cutting initiative as well as productivity. Hence, more stable yen is favorable, and this should not be a reason to actually be afraid of Japanese economic strength going forward. So one thing to highlight, yen is highly undervalued. Compared to the Asian peers that you see on the screen itself, yen currently sitting at below 2.4 standard deviation below its long-term average, means that it has a greater upside potential compared to regional peers. What our outlook for yen is that we expect a more stable path forward for yen instead of a super strong, a rapid appreciation in Japanese yen currency. A stable yen is more ideal to actually induce investor confidence. At the same time, buy some time for the corporates in Japan to adapt to a rising Japanese yen strength. So all in all, perhaps you might be wondering, at this moment, should I still position or increase my exposure to Japanese market? Would like to bring your attention to how Japan actually how Japan should deserve a place in your portfolio. In MSA Global Index, which is a reference for how much Japanese equity is being appreciated. So only 6% is being allocated in Japanese currency, with the rest marginally dominated in US equity. On the other hand, foreigners, despite has left Japan whenever there is a sharp downturn or global a meltdown in Japanese economy, they have actually returned, actually maintained a fair share of position in Japanese equity. One thing to take note here is that in the past, can you imagine Japan equity has reached a peak of 40 times PE? And of today, you may agree with me that Japan has rallied a lot, close to 20% this year. Is there more upside potential that deserve? Is there a compelling risk-reward ratio? Yes. Currently, it's sitting around 18 times, slightly above its long-term average. However, we do see some underlying issues remains and needs time to actually revolve over time. For instance, the structural reform has just been kicked off a year ago. It needs more years to actually see a transformative landscape in Japanese equity. On the other hand, comparing to DM in Asia, Japan has often been overlooked. So it should deserve a place in a portfolio for you to achieve diversification, for you to achieve not only just because to avoid some geopolitical tension that is more sensitive to particular countries. For instance, in the Middle East, for instance, in US and China is getting more crazy over time. On a relative basis, this should be the strongest point why you should pay more attention to Japan equity if you have actually leave it behind over the period. So relative to DM, relative to US and Europe, Japan currently still is very appealing. It has more than 30% of the company, a third, which is yet to see a strong improvement in its PB ratio. Ultimately, they should comply with regulatory pressure in order to actually deserve a place in the stock exchange. All in all, let's turn our attention to how actually value and actually position our recommendation. We assign a 4-star rating. It's along with the other 3 sectors and countries which we are very bullish on. It is on a very attractive scale, and by 2026, you should see about 22% estimated upside potential, which is still rather attractive. And this joined me that Japan is also one of the favorite countries when we associate with new Asian tigers. I believe that for those clients which actually follow through our recommendations since last year, we have this coming up because we see a common traits among them: global reputation and their strong innovation capabilities. They have quite a number of big corporates which are a strong competitive mode, like in terms of technology, in their market reach, as well as how strong are the client base. So all in all, please take a look at the bullish factors. And today, my focus is on the relative valuation, and this would be one of the convincing factor that you may repay your attention to this promising sector. So this brings me to the end of my my sharing. So just imagine Japan is like a bonsai tree that it has already weathered some storms. However, still it shows its resilience and the strength in the end of the day. Thank you.